Hello traders, Gary Wagner here. It is 12:22 in Honolulu, 5:22 in New York on Thursday, 15th day of December 2022, and this is the Daily Report for gold and silver. Obviously, market participants had a delayed reaction to the information provided by the Federal Reserve yesterday. The idea of sleeping on it was certainly what we saw market participants do, as we had fractional and muted declines in gold and U.S. equities and dramatic sell-offs across the board in all of the major indexes today, with gold sustaining a deep and strong price decline. Gold is currently down $31.80. That is a drop of about 1.75%, with the most active February contract currently fixed at $1,787.10. That decline was sellers participating, actively selling gold as well as dollar strength. The dollar is currently up by 0.83% and fixed at 104.60. Lastly, the candle that burns twice as bright burns half as long, and that has been the case for silver, sustaining a drop of just over 3.5%, with the most active March contract of silver currently fixed at $23.28. On yesterday's report in the proper action and market forecast section, I addressed the fact that I believe that gold was at a key and critical crossroad because of the fact that the recent highs created a double top, which is a pattern that will typically result in a correction taking prices lower. But there was another possibility, because when we converted our daily to a weekly chart, we could make a case for a rounding bottom, which would look for consolidation above what is called the neckline, which relates to the high price achieved in the double top, and then breaking with a strong rally above that. Today, it is obvious that we got confirmation that gold prices would correct. We had the highest price achieved on Tuesday of this week, taking gold up to 1837, so that we can update our Fibonacci retracement data set to properly reflect this rally, which began at approximately $1,618 or $19 and concluded at 1837. Based upon that, I say that we have minor support at approximately 1785. That is the 23.6% fib retracement. We've already broken below the 200-day moving average, so that will become an area of resistance now. And I see the first realistic support level to actually put a trade on possibly occurring at 1753 to 1758, somewhere in that area, with major support coming in at $1,725. That is a couple dollars below the 50% retracement level of the last leg of the rally. On yesterday's show, as well as other shows that I've done earlier in the week and last week, I talked about the potential for the strength of silver to begin to subside at the Fibonacci extension of 1.618. In essence, what we did is we measured the last rally in its entirety, moving from 1740 up to 2128. And then after the correction concluded, which occurred at right around $18 per ounce, we looked at the potential for a really strong leg of the rally, and a strong leg would be a fib extension of 1.618. It is the perfect way we like to see a wave one scenario play out as the benchmark to forecast or predict the price ascent of the stronger wave three. Traders, now that we've seen some strong evidence that we could have seen this leg of silver's rally conclude, moving from its lows of $18 to a high of 24.38 a couple of days ago, we can effectively create a Fibonacci retracement, which will give us an indication of where we could see support come in for silver pricing. The first level is $22.90. That is the 23.6% retracement. And then below that is about $22. It, by nature, will not go, I believe, below the 50% retracement, because one of the immutable laws of Elliott wave theory is that this correction cannot go below the top of wave 1. We are looking for this to be the deepest we would see a correction going, with my best bet where we could see silver find major support at $22 per ounce. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.